Welcome to the OpEx Effect, a joint podcast from Excess Returns and Spot Gamma, where we take a deep dive into the world of options and the flows they generate in the markets. Join Brent Kachuba and Jack Forehand every month on Options Expiration Week as they look at the major developments in the options world and how they impact all of our portfolios.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital.
So, Brent, I'm happy you're still talking to me after having to listen to me for 12 straight hours a couple weeks ago there on the live stream.
Yeah, we had a marathon of the event, and we were just talking. We're really happy with how it went, and still opportunity to watch those charity day interviews, I should say, and hopefully donate a couple bucks to Susan G. Komen Foundation.
Yeah, it was awesome. And we have the individual videos. Some of them are up on Spot Gamma. We have some up on our side, so both live streams are still up. So if anybody wants to, still watch it, it'll be up there. And the donate link, I'm just leaving it live, so anybody who wants to donate can still donate at any time. And it is a great cause. And yeah, it was definitely an exhausting, a little more exhausting than I thought it would be. I think by the end we were fading a little bit, but you would think it's not that hard, but it would just to sit here and talk. But after 12 hours, you're fading a little bit.
Yeah, and you burn a lot of mental energy there. I've always heard that you hear some people that are like professional poker players and they're there for 12 hours and they'll lose 5 pounds just because of intensive thought over the course of a day, and that's kind of what that felt like.
Yeah, no, for me too.
Burn a lot of calories.
So, yeah, thankfully we had Justin and Matt helping us as well, or we never would have made it. But they helped us get through to the end of the day.
Yeah, absolutely. And got to talk to a lot of people who I haven't spoken to before, and that was really exciting. And fortunately, we had a lot of fun stuff to talk about pre-FOMC there and the Treasury funding and all that. And here we are now. We got a couple more data points coming out this week. And so some more excitement is just around the corner.
Yeah, I was surprised, but we got through all that stuff without any kind of major, market event of any kind. The market seems to, we were just talking before we started. I think we're within 1% of all-time highs again. The market just keeps cranking.
We absolutely are. So as we talk now, we're at 5220 S&P. Record high is 5265, give or take a couple handles. And it's a market that just doesn't seem too worried about the future. I'll say that. And you can see that not only in the all-time highs or just off of all-time highs, but also in volatility. People don't want to own puts. They don't care. They're not worried about it. And that's really being reflected in the prices that we see in the options land.
Yeah, I haven't even looked. What's the VIX at? It's quite low still, right?
Yeah, the VIX is right around 13-ish here, which, is still fairly high relative to, we saw 12s over the last couple of weeks kind of into March. But what's interesting about that 13 number is that realized vol, in other words, how much the S&P is moving, is not much lower than that. So the premium or the difference between where the VIX is and how much the S&P has been moving on a volatility basis is really very small. In fact, it's like a 10th percentile small, which just tells us that there's no premium. There's no event premium, right? People were worried about hedging the CPI number or some other geopolitical number, whatever. You would see the VIX would have a much higher relative premium there. And right now it just doesn't. People just generally speaking are not too worried about the future as we head into the summer.
Are there when we see, I think what CPI is this Wednesday or Thursday or something?
It's Wednesday. So we got Powell speaking tomorrow. Then we got CPI on Wednesday. That's the same day as that CPI is on Wednesday. Then we have OpEx on the 15th. And then next week we have NVIDIA earnings, which I think is a big event. And that's the same day as VIX expiration. So, a bunch of catalysts kind of stacked up here.
And you don't see any concern right around CPI or anything like that? There's not I know there's usually a 1 day little spike there or something. You don't see any of that, right?
So we have a chart of that here in the presentation about term structure. Yeah. And so we could talk about that, but what's interesting is there's a small premium for tomorrow for Powell. Then there's a bigger relative event ball premium, we call it, for CPI. So people do care about CPI, relatively care about it. If you look at vol 3, 4, 5 months out, it's very, very placid. People are not worried about things. There's a little bump in vol around the expiration dates, but other than that, we're kind of at 90-day lows roughly in terms of volatility levels. And, there were some very calm periods in those 90 days. Yes, April was a little bit, louder and more violent than it's been, like it's volatile than it's been. But, the context of years of volatility, things are very quiet right now in the context of years of volatility levels, that is.
All right. So before I get too far ahead and keep talking about slides that we're going to talk about later, we should probably start with what you actually have in the presentation, which is, at the beginning, we always like to talk about this OpEx cycle. We have options expiration coming up on Friday. Can you talk about a little bit about this cycle and why it's important?
Yeah, so part of the reason we do this, the OpEx effect when we do it is because it's right before options expiration. So options expiration is Friday. And the way that we view this cycle taking place is that options expire, and then over the course of 30 days, big positions build up. And those could be calls or puts leaning one way or the other. It could be a fair blend of both. Right now, we have a lot of calls building up. And with that, we see hedging flows associated with those positions build up. And that sort of reinforces flow. There's a lot of reflexivity in that. And then when options expiration hits, those positions clear out, and it allows for the market to kind of reset itself, for positions to shift and change. We see that in statistics. We're actually doing an OpEx statistic report that we're going to be putting out here, trying to get it out for tomorrow. And we do see this volatility expands. And we talk about volatility expanding, that simply means markets are more free to move. It doesn't always mean up or down. It just means we're going to get more movement than we've been getting. So in this case, we have Powell tomorrow, CPI on Wednesday. Those are the events that are going to occur into a time when options are expiring, which allows for more relative movement. And that's what the general idea is. And you can look at this on a single stock basis, like a certain name is building up big positions, or on the index side of things, obviously like with the S&P 500. And so on this chart here, we show a 5+ year history of the S&P 500, and each X is an individual expiration. So not every single expiration is this big, massive turning point. Quarterly expirations seem to be big turning points. And also what is also an interesting turning point are put heavy expirations. And the idea is that if people are buying lots of puts, that puts on negative delta dealer hedging flow. So what does that mean? Dealers have to sell a lot of shares or futures to hedge. And then when those puts expire, the market often rallies. And the reason I bring that up is because the most famous ones are December of 2018, the Monday after was the low of the market. March of 2020, same thing. The Monday after March options expiration was the low after the COVID crash. And actually, April was the low of what was the most volatile period we've seen in months, right? Options expiration was the low, and we just bounced from there and have ripped higher, as you can see on this chart. So, these options expirations, oftentimes when they're clearing, particularly very big one-sided positions, meaning all calls or all puts, when you clear out that imbalance, it can often lead to a change in market behavior.
Yeah, I didn't realize April, like if you look on this chart, I mean, April really was like the turning point. We've seen a lot that weren't turning points for a while, and then April really was the bottom.
Yeah, and we've been, particularly in the S&P flow, pretty neutral, right? Like, yes, there was more calls, but a lot of the focus has been on single stocks, and there's been a relative whimper, I guess, on the position size that we've seen really over the last, call it 6 months. But April, because of how sharp the market moved down, it had built up a lot of puts, and volatility was relatively high. And once you clear all that out, we clear out those positions, and then we got a little bit of a dovish Fed print and CPI print, Fed statement after, and that just allows the market to really rally because those positions are out of the way, and the market can retrace. So the current area of operation last into April, we were really looking at bigger positions in the 5,100, 5,000 kind of area. Here we have our big support levels at 5,200. That was the recent high last week. We've now moved up to just 5,220 there. But now what you can see is that it's become a real two-sided strike. And what I mean by that is the orange line, which is call gamma, and the blue line, which is put gamma, very even now. So we see that as a real support line. You can also see 5,225 and 5,250. That the gamma is all stacking up at this area. And this has been what we're forecasting is the high into options expiration. Now it's going to happen at expiration. We're going to reduce the size of these positions by about 25 to 30%, which means that the market can kind of move again and things can reset, which should allow for some more, again, fluidity or more volatility relatively to pick up.
Yeah, and it seems like we always have, that must be 5,000, that other one outside of the zone there. It seems like we always, at those round numbers, we always have, decent activity.
Yeah, that's a huge strike. It was a huge strike for a long time. It was a huge strike before it visited that level into April OpEx. The low was 49.85, somewhere around in there. And there's some big financing position box trades, we call them, that sit there, which have nothing to do with sort of directional bets. But there's also just a lot of other two-sided positions, we'll call them. And accordingly, the market hit that level and it really stuck. There's also the JP Morgan collar trade, which we talk about a lot. That struck at 49. 49.80 right there, 49.75, 49.80. So that's another big kind of support level just in that general vicinity. And the market bounced right there. It held. Again, OpEx cleared out a bunch of these positions and we rallied. And so, if we do get weakness out of CPI, and if Powell comes out very hawkish tomorrow, then, that 5,000 area is one I think we're going to visit probably pretty quickly in the event of a hot reading, because people aren't positioned for that hot reading at all.
So is the idea with a level like that it acts as resistance, but if we were to break through it, then that becomes bearish, right? That we're likely to accelerate to the downside. Is that the idea?
Yeah, that is the idea. And so the way that this, sort of works in my view is that, you kind of got to get the energy to catch hold, right? And a lot of that is either you got to get the dealer position big enough that they're driving things. So in other words, if they start to short the market, that flow get big enough that it becomes the major driver of the market. And I think if you break 49.80 area, which is where that JP Morgan strike is, then those dealer flows can really start to pick up in a way that drives one-sided market action, right? And that's what makes the VIX spike and the like. A lot of these other strikes that are balanced, when I say they're balanced, they have a lot of calls and puts, the flow becomes balanced as well, right? You get a little bit of shorting under that level and it kind of pops back up, and we end up more rotating around those big strikes as opposed to seeing, one-way movement. So, again, that's why this balance is important. And to your point, Jack, if we get below that really 49.75, it's where we break the pull of that 5,000 and the flow should become much more, omnidirectional, right? Let's just start selling flows, VIX spike, that's where things can get kind of nasty.
Just one more before we go to the next slide. Like, are these levels, now that there's way more options activity out there, are these levels like more important than they used to be? So if we looked at this like 5 years ago, I assume those lines would be not nearly as tall or in both directions as they are. Does that mean like the levels become more important because there's more going on there?
It's very interesting, and you bring up a good point. There's two things about this. So 50% of volume in the S&P 500 now is 0 DTE. That means those are contracts that expire today. They have very little position to start the day. It's just a bunch of volume that takes place. And so that flow, in our view, in all of our studies, drives mean reversion in the market on a daily basis, right? And so that means that if we rally in the start of the day, the market tends to sell off, and if the market dips, it rallies back. And we saw that actually even through the weakness, that there was relatively less kind of intraday ranges or lower volatility. Now, there's still these bigger positions. So the big funds will still position at 30 days, which is the monthly expiration, and then the quarterly expirations are the biggest. So we still have these cycles. And those cycles still matter because there's these big gamma positions. But what happens now is the 0 DTE people will anchor to those strikes that already have a lot of open interest. And so you do, I think, see faster cycles. So like the vol is higher now because you get these 0 DTE flows that come in and are gone. And so, you look at like today, we have big gamma at 5,000, big gamma at 520, which is the spider 520 level. And you'll see how the 0 DT flow come and glob onto those strikes, right? So there's a lot of like, you end up with 0 DT traders, you really being able to use this information, I think, strongly. And then like monthly traders having a lot of success, but then there you get those tweeners, right? Like if your focus is a few days out, things get a little murkier for you. Basically what we see.
Okay. So on this next slide, we had actually made a big left move for a while. We were thinking we might get a little volatility. Now we seem to be way further right.
Yeah, into March, into April OpEx, the line right here was just below 1, and that forecasted a lot more relative volatility. And what's interesting is we had put out this presentation about vol suppression. You can find out on the blog. We're talking about the streaks of days without a 2% move up or down. There was all these signals that things were kind of like starting to crack a little bit, and that volatility estimate was much higher, right? Because when we slide lower on this chart towards the left, it infers that we get more forward market volatility. So it's a predictor. Now we're very extremely way up to the right, which means that there's no signal that today or tomorrow we're going to have volatility. But as we know, we're going to get expiration, which is going to clear out some of this gamma, and it's going to make this index, the level on the index current reading, which is about 1.75, we're going to shift towards 1 because we're having options expire, right? Options expire reduces the positive gamma we have, and volatility should increase in kind.
So on this next slide, May is not a major OpEx.
100%. You can see June is the big one here. It's just the size of positions. We refer to those big funds. You have biggest funds in the world can't day trade, right? Their positions are just too large. So they'll tend to position at the quarterly expirations. That's what you see here, where June OpEx is about 3 times bigger, 2 to 3 times bigger than the May. and may have a lot of call positions now simply because it's a function of the rally. That's supplying big positive gamma in the way that big positive gamma is edge suppresses volatility. And that's the environment that we're in right now. So we're looking for, at a minimum, small positive gamma, decline in positive gamma readings, and a little tick up in volatility is the base case as a result of what you see on your screen.
How do you think about, I remember you and I interviewed Jem Kersan at our charity day, and there were some expirations earlier in the year that he was concerned about, like the window of weakness around, that if things had gone the wrong way, they could be significant from the market. But I think he's less worried now going forward. Like, how do you evaluate these types of expirations? I mean, obviously the size is probably one thing that's important in terms of it could be like a turning point, but how do you think about them like that?
Yeah, the window weakness thing is funny because that and we did a member Q&A earlier today, and someone asked nearly the same question. So it's kind of funny. And if you think about 2021, the market went up just like a rocket ship the whole year, and people would buy tons of call options, and then at options expiration, the market would get a little bit weak in the days after options expiration, and then that dip would be bought, more calls would come in, and that happened just every single month, right? And I think that's where this idea of window of weakness really started to grab hold, because all that call buying would come in, and then again, when those calls would go away, the market would get a little bit weak, and there's your window of weakness. I think you should frame it as a window for volatility. And if you look, there's very compelling data that says that the market tends to be less volatile into options expiration, whether or not there's a lot of calls or puts, even if there's a big imbalance, tends to be less volatile into options expiration and more volatile after. So if you just look at how much movement we're getting. Now, is there a catalyst for the market to rally or sell off? Now, if we're losing a bunch of puts, right, then I think there's oftentimes a lot of hedging flow. It causes a pause in volatility, which leads to buying. This is sort of Vanna flows. There's a lot of reasons for the market to bounce and reverse after options expiration when things are very negative. When we have this situation where there's a ton of calls expiring, in this situation, we're going to lose a bunch of calls, but that's going to come into the CPI data, NVIDIA, Powell speaking. If all those are dovish, right, or bullish for the market, then the function of losing calls allows for a little bit of market movement. So we could slide up to 5,300, which would technically be volatility because we really haven't had a 1% move in a couple of weeks now. And then we would just get positive gain, which is glom on again, right? And we'd just sort of get back into this grind, right? Because calls are going to get sold, position's going to just build back up, and then it's going to be business as usual. So there's this window for volatility to expand, right? And that happens to the upside or downside in this scenario. Now, I mentioned the upside. If we go to 5,300, we just kind of enter the grind again. We talked about 5,200 before. This is a real chance for the market. If it breaks 5,200, then we can have several days, right, or weeks of expanded volatility. So that's how I like to look at it, volatility expansion. And if you can get a directional lean out of the way that people are positioned or events, then that plays into the volatility expansion.
So it's less about weakness and it's more about we're free to move around more.
Yeah, I think the weakness comes too when you see that people are really skewed. So, you have a situation like in GameStop, so 100%, right? Tons of Friday options are trading. People are just buying calls. It's very skewed. When you have that event, long calls, it's 100% long calls going to expire, then stock will tend to get weak around that, right? Same with puts. When everyone's long puts and they all expire, that leads to some mean reversion. In this case, people are mainly short calls in the S&P. And so, that opens for a little bit of volatility, but we need a catalyst, right, to make that volatility really extend over several days as opposed to just a short window where things move around a little bit more and positions basically reset, and then we, continue business as usual, which is kind of what my forecast is here. Like past Powell, past CPI, no big deal, and the grind continues.
Yeah, on the GameStop thing, I saw Roaring Kitty had tweeted some sort of red arrow today. I don't even know what he's talking about, but it went crazy on Twitter. So I don't know if he's talking about GameStop or I'm not smart enough to figure out what he's talking about.
Of a guy leaning more forward in his chair and I'm interested now or something. And so GameStop was up 200%. Paused several times. And
yeah, so somehow he was referring to GameStop in the tweet with that.
Look, what's so interesting about this from my perspective is for a brief moment in time in April when things were very weak, things turned to the macro, right? People were very worried about, what's the VIX doing? What's happening in the market overall, geopolitical, race, it. Now suddenly that conversation has just totally gone away. And if you see GameStop up 200%, that's a sign of risk-taking and speculation in the market, which is, I think, healthy if you're just a bull, right? Because that tells me that there's a risk appetite out there, in other words. the more focus is on single stocks, I think it's a better barometer for the macro environment, I guess is what I'm trying to say.
I'm just curious. I don't want to get too off track here, but is that 200%? Is options playing probably a significant role in that happening?
It's very, very large options volume today. I mean, the implied vol, I looked and it was, the market's getting halted. That stock's getting halted a lot, so the vols can get skewed. But I was seeing, numbers like 400% implied vol, which is just absolutely insane. So the stock keeps getting these volatility halts, which messes with the options market a little bit. But, we're seeing very, very large levels of call line. Nothing like 2021, but, clearly they're very elevated. Not only in GameStop, but also AMC, which has nothing to do with GameStop, but
it's just funny. We're in a world where basically somebody tweeting someone sitting forward in a chair has basically caused a 200% move in a stock.
He hasn't used his Twitter account, I don't think, in like 2 years or whatever it is. So, he's coming out of hibernation apparently, or maybe not. Who knows? I don't know what that means, but there's clearly a lot of risk appetite out there, and I think it's very interesting.
Yeah, no, we'll have to talk about. We'll see what happens with it. Maybe in a future episode we can dig into that a little bit more.
Yeah.
So yeah, or what's moved? So you're going to talk about what we talked about last time and how things played out after that.
Yeah. So in early April, if you go to our blog, spotgamma.com, and click free resources, we did an article about the lack of volatility in the market. And one of the highlights was this streak of not only lack of down days, 2% down days, but also lack of 2% up days. And we picked 2% as this barometer for, a several standard deviation move in markets, but we just didn't get major down days, and we compared it to previous very odd periods or unique periods in time. And so this presentation we put out on 4/7, obviously volatility did expand quite a bit. The VIX spiked to 19-ish. Interestingly enough, we didn't actually get a 2% intraday down move despite the weakness that we had. So still didn't quite get this full, for lack of a better term, puke. Like we still didn't get that capitulation day, whatever you want to call it. Which is interesting, but certainly volatility did increase. Now, a lot of those flows we believe were driven by systematic call overriding. So we talked a lot about that in other episodes. Please go check that out. And zero DTE flows. I think those are both combining to suppress volatility. Now, if macro set is going to come out and sell because rates are going up or whatever the narrative is, those macro flows are still possibly set to determine direction. But I think the options market is determining how volatile or how fast it is that we get there, right? And if we overshoot, expectations as well. What do I mean by that? Is like macro wants to start selling their stocks off to go and reweight to bonds or whatever other asset class, the market is going to go down. And if people buy puts, we're going to go down faster, right? And if zero DT flows aren't there to kind of buy into dips, we're going to, we would normally go down faster. So, this fact that we're still not seeing a 2% down day and whatever it is, 450 some odd days or something like that now is, to me, still very strange. So that was the dynamic going into the start of April. We thought that volatility would shift. And tied to that was there were what we called persistent flows at risk of unwinding. So a lot of those are what we just mentioned. We're going to touch on these today, but there's been a lot of big single stock flow. So people focused on the semis and AI. That was the theme into March, heavy call skews, we called it, all these things. And then as soon as volatility poked its head out, people were very focused on macro, right? Correlation shot up, which means all stocks went down. Obviously volatility increased, measures of dispersion started to shift. So if you think about, how good the chip sector AI trade was going into March, really, and end of April, and how much those names are outperforming the broader market, that outperformance mean reverted hard, right, into this April sell-off. And we seem to get a pause, in that relative trade, meaning that yes, AI and chip stocks bounced, pretty strongly over the last couple of weeks, but they're not accelerating away from the whole market yet. I think NVIDIA could trigger that, but there was a reset in some of this dispersion, I guess I would call it, that we saw into April.
We didn't get a 2% update either, did we? So is this streak still holding on both sides?
We did get one. It was after NVIDIA earnings. So NVIDIA had blowout earnings in February, and that was a 2% update.
Okay.
And we haven't had a 2% update. I don't think we have since. So, there's one little blip there, but technically the streak was broken. But to your
down
point,
streak is still holding.
Down streak is still holding. The up streak is, did get dinged. But yeah, you're right. We've had a lot of successively strong days over the past week. Like we at one point, I think, had 6 days up in the Dow, for example, which I think was a record. I have to fact check me on that one. But What is it, like the string is like every day is like buy, 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 as opposed to us getting like, hey, we just made 4% today. One single day blow off. We end up getting like, 4 days of 0.5% move kind of thing.
So on the next slide, you're talking more about this idea that April marked the low.
Yeah, I mean, it was really to the day, and I like marking these things because oftentimes people go, I just don't see it, and so like when you have an event like this where you lose big put positions, you really see that kick in, and then so we're going to approach here May OpEx, and what's going to be so fascinating is if we do get. We could get an interesting kind of path dependency, right? If CPI is hot, Powell's kind of hawkish, then the market could actually get pretty weak pretty fast into March OpEx. So in March OpEx and the VIX expiration, and if VIX is and falls really high into those events, then I think it could change the dynamic of what could happen over the next couple of days. I don't think, I'm not a macro forecaster. I just think generally speaking, you want to bet against these prints meaning something, right? Tail prints, you just want to bet against them, I think, as a general idea.
And we have the VIX expiration and OpEx are different ordering this time relative to what they have been.
Takes place, the VIX, it's about half and half. VIX expiries before OpEx. And we find that volatility is much higher during those periods than if the VIX takes place after OpEx.
Okay. And this time it's reversed from last time. Is that right?
Correct. So next week is NVIDIA earnings and VIX expiration on Wednesday. If the VIX is low, 13s, and then I think the VIX expiration is not all that interesting to talk about. It's when the VIX is very high, say 15 plus, where I think there's actually a much more noticeable market impact.
Yeah, I would assume like back in 2020, like the VIX expirations were significant when VIX was going crazy.
And even in 2022, we would see very strange rallies on the Tuesday before expiration. So VIX expiration, the contracts expired the 9:30 open on Wednesday. And so you see a lot of positions shuffling on the Tuesday before as a result. And there were some very unusual market rallies that occur when the VIX is very high, because I think that vol gets kind of sold off and it pushes the stock market up on that day before VIX expiration. It's a flow we've noticed for sure. The problem is statistically speaking, there's not all that many VIX expirations where the VIX is really expiring, right? So you can go, okay, like we have a sample size of 3. We rallied 3 of those times. Like, if you want to bet the farm or that, I don't know. But here's VIX expiration. Just again, that kind of marked the high there with the April equity OpEx. Really cleaning the deck, and vols have gotten slammed, right? I mean, the VIX went directly from 19 down to 13, and now you see the VIX is bouncing a little bit here as traders are waiting for the CPI and some of these other interesting events to take place the next couple of days.
Yeah, on this next slide, we're talking about correlation. It's a funny story. Like when you and I were interviewing Mandy Zhu, thankfully you carried that interview because she was so smart, like about all this stuff. And she was talking about dispersion and correlation. And I was like, Jack, please be smart enough to ask a good question. Like one good question, like come up with something, because I couldn't, it was well over my head, like the type of stuff you two were talking about. I finally got something into the end that it was probably not that intelligent, but I would recommend anybody take a look at that interview too. But now we can go into your discussion of correlation.
Yeah, I mean, they say, intelligence is shown by how well you can teach something, and she really just outlined those topics so beautifully. Everyone should go check those out because the questions really were around, hey, like how can non-options investors, right, macro folks, those with a long view, look at measures of correlation and dispersion and extract some information. And so in this case, what correlation here is measuring is, this is 3-month correlation. So what is the implied correlation? In other words, how much do we think all stocks are going to move together? So what this does is it looks at the implied vol of the top 50 individual stocks in the S&P 500 at their implied vols and compares them to the S&P. So the lower this goes, it means that single stock implied vols have a higher relative level than the index, which simply means people think that single stocks are going to move a lot more, right, relative to the index. And that's a condition that I think, again, like I said before, a lot of people go, well, no duh, right? But this is a lot more than we're historically accustomed to. And so this measure of 3-month correlation is at all-time lows, but into April OpEx, like you can see here, it had dropped really low. So as soon as that April weakness came, this correlation measure snapped higher because everything started to move, focus moved to macro, semi stocks and AI stocks stopped outperforming. And right now, I think we're sitting in this moment where it's like everything is, I would say, fairly valued, and we need a narrative to glom onto. If NVIDIA earnings are blowout, then it's like, great, let's all jump back on this AI train, the semi-stock train, whatever it is. and we can start to build this correlation back to lows and those semi stocks outperform. If rates can really come down sharply now because of CPI, then maybe different sectors pop their heads up like small caps or whatever. But if the market starts to get weaker and we see this correlation move come up, then I think that's a signal that the macro concerns are really picking up, and that has bad implications for a lot of stocks that were outperforming, right? They should really start to come in quite a bit harder if we see these correlation measures start to increase.
And correct me if I'm wrong, but Mandy was talking about the idea that like in this recent decline, correlation didn't rise like you would expect it to, right? Like you would expect, they always say like correlation goes to 1 in a decline, but it didn't really happen as much in the recent decline. Is that right?
Yeah, that's right. So if you look at this big spike back here in 2020, correlation really jumped and the VIX went to, 80 or something, right? And that's because every single stock got sold. It didn't matter what it was, it got sold, right? Banks and cruise lines and whatever, everything, all equities went up because equities were getting sold and people were rotating into more safe assets. So that's extreme correlation. Now, in this case, to her point, correlation increased, but didn't go that crazy, right? And I think what a lot of that is there was these macro concerns, but then there was a lot of single stocks that were outperforming the downside. So like NVIDIA went from outperforming really sharply in the semis, they were down much sharper than the broader market, right? So you got some correction in some of the, what we say like dispersion that the market had as the signal into April. And if some of these things are a little bit confusing, please go to spotgame.com. We wrote a whole blog about dispersion and correlation, and you can really dig into some of these metrics, as well as the Mandy Zoo video from the SIBO. It's on Excess Returns YouTube.
Yeah, but it's in the, I think it's just in the live stream right now, but we are going to, at some point on one of our channels, we're going to publish the individual one as well.
Awesome.
So yeah, moving to our what is moving, looking forward instead of back. What do you got?
So, this, obviously April was about the volatility spike, right? And we bounced violently back from that volatility spike. And what is happening now? Here's from our vol dashboard. This shows you two things. Interestingly, here we have 1 month S&P skew. So this is the implied vol readings from 1 month options in gray. And it's a little tough to see here, but there's a shaded gray cone there. That shaded gray cone is the statistical range at the time for 1 month skew. And as you can see, into mid-April, which is when the market was testing 5,000 and things were very volatile, that skew reading, if you can tell it there, Jack, it's above the 90-day range, right? So it's very high relative implied vol, which makes sense because we were at 5,000. The market was down, 5-6% into that period. People are a little bit worried. Now what's happened in the green line, if you look at 1 month skew, we are now at 90-day lows, right? That's what that green line is telling us, and it's below its green shaded cone. You can also just compare the gray line to the green line and see that we're clearly much lower, right? And so what this is volatility's come way down. The shape of skew is not shifting all that much, meaning people aren't really buying or selling necessarily out of the money puts or options. It's just that vol writ large is just really deflated. And this is a risk-on environment. This is an environment where people just aren't very worried about the future. What's interesting to me is they didn't get that panicked into the teeth of the selling in mid-April. VIX went to 18, but that wasn't, that crazy. Skew never really went that crazy. It just seemed like they're kind of like 2022. There just wasn't this big demand for options, despite the geopolitical concerns and the rate concerns. So,
and just for anybody who's not familiar, skew is a function of the demand for puts relative to the demand for calls. Is that right?
Well, there's a couple ways to look at it. You can look at how this curve shifts. And the idea is that if there's demand for puts, right, then skew will lift. So if people are buying, 20% out of the money put options, the implied vol for that level of options, should increase, which would steepen skew. And same thing to the calls, right? So they're independent of each other. But you would see this skew or the shape of these lines would steepen or flatten out based on demand to your point.
Okay.
So you can look at a single stock, S&P always has very heavy put skew, right? Puts always have a much higher implied vol than a call. So like a 10% put has a much higher implied vol level than a 10% call. You could look at another name like GameStop today and you'd see the opposite, right? Calls would have a much higher implied vol than puts. So it's quite often in single stocks. And to your point, it's often supply and demand driven.
Yeah, that makes sense.
The takeaway from this flow too is when you see vol get squashed like this, it's a signal that I don't want to jump to this other slide. That's what we call oftentimes Vanna flows, right? And I thought I had popped a chart in here. I don't see it in here. But what the Vanna flows are is simply when implied vol changes, we believe in the option space that drives underlying hedging flows, which moves the market. And so when you see that gray line shift down to where the green line is, that's vol getting squashed, right? And that leads to flows that boost the market up. And so what's interesting is we had a pretty neutral level of volatility last time we were in this area, 52.25, right? Vol spiked. We sold vol back off to where it is today, and the market basically just is at the same level, right? So we just did this round robin, not only in terms of the S&P 500, but volatility writ large. I mentioned before, we talked about at the very start of the presentation, there's a small implied vol premium for Powell's speech tomorrow, and you can see this little data point here, but more so for the CPI. The CPI is what the market is hanging on. You can see that because this is what we call term structure for the S&P, and each one of these, each expiration has a implied vol data point. So the implied vol data point for CPI reading on Wednesday is higher than every other data point in this curve, which tells us that is the reading that traders care about. And then what's also interesting about this, so CPI matters. We're at the bottom of this shaded cone, which is the 90-day statistical range. So when you look out in mid-June, mid-July, these implied vol readings are at 90-day lows. Nobody's worried about the future. So you're talking a 12% implied vol, which is like people forecasting, 60, 75 basis point daily moves in the S&P. Very benign, right? People just are not worried about what's set to happen now, 2-3 months in time. It's a real kind of risk on market. And to that point, you can look at this market as there's a little bit of tail hedging in case that CPI print comes in hot, but no one's really positioned for like a record CPI where suddenly people, okay, like rates are going to stay higher for a lot longer now. We got to really shift to that mentality, which, people aren't hedged for that. Then the likelihood of a big down move happening increases in my view, right? Like if you're expecting a big move down and everyone's hedged for it, it makes it harder to actually for that move to manifest, I think.
Yeah, and people aren't that hedged. I mean, basically what's been happening with every CPI seems to be slightly hot, which hasn't caused major moves. But if we got really hot, or really, well below, I guess we would have to, that would be interesting to see how that plays out.
Yeah, 100%. Powell speaking, this week, he speaks next week, you got FOMC. So, we're going to continue to get these numbers. And I just think that unless the market is just, really just hit over the head with a hot inflation number that it can't explain away, then what happens is, to the point of Vanna flows, people go, okay, CPI didn't really mean anything. Sell that extra vol that had been built up, sell these puts that we were holding, and that helps to push the market up. And that's why I think if the reading is benign, then 5,300 by Friday, I think is what happens. 5,300 in the S&P.
It's always funny with inflation too. There's so many ways to slice and dice the number that, like, no matter what your opinion is, if it's hot, if it's cold, like, you can always come up with something. You can do the 3-month annualized, the 6-month annualized. You can exclude this, that, and the other thing. Like, there's just, you always see both sides, no matter what the number is, like, coming out with their, I've dissected the data and here's what supports my opinion.
Yeah, and I think it's so hard to navigate all that. I don't envy the macro folks out there because it's such a changing dynamic picture. And I like looking at the implied vols because that tells you what the market is expecting and what the market is pricing in. Like to the point, where they were pricing in 4, 5, 6 cuts right at the beginning of this year, and now the market's maybe pricing in one sometime out in the future, but we're still at record highs in the S&P. So it's like, who cares, right? And that's what, when I look at this, people are saying we don't care. That's what I see in the implied vol space. And so, it's fun to talk about this on Twitter and all this stuff, but I think overall the message I get from the market is, unless it's a tail print in the CPI, we don't really care. And if you don't care, I think the natural movement of the market is drift higher.
That makes sense. How about on this next slide? What are you seeing? This is always interesting to me, like looking at cross asset volatility. What are you seeing there?
Yeah, this is from the aforementioned Mandy Zhu's volatility dashboard. It's puts out once a month. If you go to SIBO, somewhere on SIBO website, you can find it. It's really great. But you can see that cross asset, if you look at equity vol, rate vol, oil, FX, credit, all that spiked into mid-April when we were worried about rates and geopolitics, all that is completely mean reverted. So vol is now back to where it was. Across asset to where we were at the end of March was a very calm period. The only vol that's still elevated is gold, interestingly. So that's still quite a bit high. And I just think it's fascinating with all the talk about rates still. S&P vols at lows, as you can see on here. But when you look at TLT, LQD, HYD, those are long-term government bonds. What is that? High grade and low grade corporate bonds, or corporate debt. All that vol is very low, right? So as much as we all kind of want to wring our hands around the importance of upcoming data points, vol is not doing anything. It just doesn't care. And so, again, if we just get even if it's a little warm in terms of the inflation rate, I think people are just gonna be like, I don't care. And market goes up, and we kind of pick up new highs. That's what all this data is telling me, right?
Yeah,
It also tells me if we do get that tail print though, just to adequate, that ball can travel a lot more, right? So if we break 5,200 and it is a real risk off move, then ball's going to travel farther than people expect because we're at such lows, right? We got a long way to go.
Yeah, it's interesting because for a long time, like the move was really what was high. Like the volatility was in bonds, and now that's kind of everybody was debating, whether the VIX was going to follow and whether volatility in equity was going to follow, and now bond volatility has come down a lot from where it was.
Yeah, that's exactly right. And so it's like I'm positioned now for a market rally to 5,300 on Friday, and then I think we'll, depending on NVIDIA, we'll then maybe make a second leg. But in this environment where vol's already low, you can wait to see that first shot across the bow, right? If we break 5,200 and vol starts to increase, then you can afford to go, okay, now I'm going to enter some puts because this could go a lot farther, as opposed to having to hedge before the event, if that makes sense.
That makes sense.
And what's also interesting to this point about it being a fair value or neutral zone is this is call volume in blue and it's put volume in orange. And what was interesting is we had very near record highs, or at least a very significant spike, I should say, in single stock put volume, which is what these orange spikes were, into the April weakness. And actually, if you took call volume, put volume and subtracted put volume subtracted call volume, we actually saw this spike when we put it on Twitter. We saw this spike that we're like, hey, this really looked like overbought. Puts are overbought, right? And what I find interesting about this is that call buyers on this dip didn't, they came in a little bit, but this is not a real breakout, right? A real persistent increase in call volumes. People are waiting for a signal right now, just as they're not worried about, I think, 2-3 bounce out in time. They're also not showing that they're terribly interested in getting long right now either. So I think what people are waiting is for like a narrative or like a clearing. And so, that clearing comes if Powell's, neutral, if CPI is neutral, if NVIDIA is like, hey, we're making more money, then I think then suddenly that call volume picks up and we get that signal, a bull market sort of phase 2 kind of thing could really kick off out of all this.
Yeah, so in this next chart, you're looking at NVIDIA, just on a separate issue with them. It was interesting talking to Gene Munster and Doug Clinton about this, because they were, they're kind of behind the, we're looking at this stuff. They're behind the scenes, like in the tech world, like investing in this stuff. And, just interesting, like seeing them talk about NVIDIA and talk about AI and, where they think the future is. I think that's interesting because I don't know a lot about the behind the scenes stuff on this tech stuff.
But they said that the moat, NVIDIA just is like, I'm paraphrasing it, but they're like, fairly valued, huge moat is kind of what I took from that conversation. I'll go listen to your, everyone please yourselves, in case I got that a little bit wrong, but that was my takeaway from their conversation.
Yeah. It's interesting just on the fundamental side, which is a little outside of what we talk about here, but like NVIDIA went up a lot, but it's like earnings went up a ton too.
Yes.
Like it's sales. This was not like a 1990s.com thing where like not much was going on the revenue side, but the stock went crazy. Like this, who knows whether I'm not smart enough to know whether there's staying power to it or if anybody can compete with them eventually or prices will come down or anything like that. But it was like their fundamentals went up a ton as well.
100%. That was the last time their earnings, the last 2% rally we had. So much of our March conversation was about the NVIDIA GTC conference. I don't know if you remember back then. It was like their Apple thing. And you remember, this relates to the slide here. Remember, we were talking about how heavy the call skews were into that event. Everybody was expecting, just like the God particle to come out of that event. And as a result, you could see call skew here. This is the 314 call skew. So right before that event, you could see that out of the money calls were extremely elevated in implied volatility terms versus at the money, right? It looks like a skateboard ramp going up. And that is demand. People were thinking that, holy cow, like they crushed earnings. They're going to crush this. And I think I don't know, maybe they put good products out, but expectations are so high that it's almost impossible to exceed those expectations that were out there for them, right? Like, oh, they didn't give us the God particle, so these calls are too rich. What's so fascinating about this time around is, yes, we still have a week for earnings, so people can bid up, these vols a little bit, but you see how flat skew is right now, 1 month skew. The stock is basically back to where it was into that GTC conference, but the vol's way lower into earnings, which I think is really fascinating here. People are not fully bulled up in NVIDIA like they were, just a month ago, 2 months ago, kind of end of March. And so in this situation, to me, I think that if they crush earnings like they did before, the stock could really run and it could really have staying power is what I'm taking away from it. Vol's still elevated across the board. Like the surface we call it is elevated because of earnings. There's always a little bit of a higher implied vol. The difference here is you just don't see that call skew. And that tells me that there's not this big imbalance into calls like we used to have. So that could really open an opportunity for the stock to rally. I think it's a really interesting moment for NVIDIA where the expectations aren't what they were, but they could still deliver on earnings.
Yeah, that expectations is so important. And like for me, as someone outside of options, like that often explains why I see something happening in the market and it doesn't go the way I think. Like a company you think beats expectations or beats like what are the Wall Street expectations, but the reality is the expectations, implied by what was going on in options were actually a lot higher. And the thing goes down when you think it should be going up. Like you see that all the time. And like learning behind what's going on behind the scenes with options has helped me to at least understand, what that is.
Yeah. And it's about probabilities, implied moves and those kinds of things. And I think that even if you don't trade options at all, you're a long only investor, you can use the options market's expectations and pricings, I think, to fill in a lot of great information for you as a long only investor. Like, well, what is our view here? Where should we put supply and demand, support and resistance? What is supply and demand? What is the market pricing in here in terms of moves? Does that fit with our expectations or not? I think, there's a lot of interesting, data in that for adjusting allocations and different things like that. I think it's kind of an untapped resource, to be honest.
Yeah. And even if you don't do anything with it, just using it to understand what you're seeing in front of you, like it to me has been really valuable. Like I don't do anything with options, but like it explains things that I'm seeing in the market. And also like there's a lot of stuff, in terms of just understanding probabilities and understanding all kinds of stuff, behind the scenes that is just very useful as well, even if, you don't do anything specifically with options.
Yeah. Yeah. And, a lot of that is just sentiment. Even if you don't want to buy into dealer hedging flows and stats buying that support those types of views, you could just extract a lot of sentiment from it, which I think is really, really quite valuable. And we've seen some situations in the past month with Starbucks, Uber, some of these names are down 20% after earnings where the options market didn't buy those lows. They were kind of fading off those lows. And that proved to be short-term lows in those stocks. So, there's a lot of information there that again, I think is valuable, even if you're only trading equities and not trading the options.
So on this last slide, you've got the waiting game.
It's a complicated last slide. It's just a path here of that JP Morgan strike down here below. So the key takeaway here is that, look, if we break 5,200, which is this support strike, I think we very quickly trade to 5,100. And then the risk is a further kind of visit to that 5,000 area, particularly if NVIDIA is just not that great of a number. Then that 5,000 should be major support again, like it was into mid-April. And to the upside, there's two interesting levels. I think after CPI, you got this 5265, which is the previous all-time high in the S&P, and then you have a bunch of spider call positions at that 525 spider level, which lines up with 5265. So between there and 5300, we have this resistance area. So I think after CPI, assuming that all goes fine, we move up to that area and we're in the kind of 5265 to 5300 area for NVIDIA earnings. And if NVIDIA earnings are good, particularly with that call skew not really there, I think that we could make a fresh leg higher, fresh all-time highs into the end of May is kind of how I'm looking at it. That's the scenario that I'm really kind of banking on. People aren't really demanding much hedges. So if we do break 5,200, then I think you can enter hedges, if you're buying puts or put spreads or whatever it may be, because there's a lot of room down, right, to 5,100 or even 5,000, depending on how the combination of CPI and NVIDIA earnings goes.
Yeah, well, I think that's a good something to wrap up on. I know you got to go somewhere. Maybe someday we'll get to the point where you and I will tilt forward in our chairs and stocks will start moving 200%. But I don't think we have the audience yet for the OpEx Effect for that to happen. But hopefully that's coming someday in the future.
That's right. That's too funny. So we'll have to play that meme somehow. But yeah, thank you very much for having me on again here, Jack. It's a real pleasure to do these OpEx, regular OpEx Effect videos, because we get to check how we've done. We get to frame everything from a little bit of a longer perspective.
Well, on that we can wrap up, but it's good for me too, because it just helps me understand what's going on behind the scenes. And hopefully, even for longer term investors who aren't involved in options, hopefully this helps to explain, what you're seeing a lot, because we know options activities increased a lot. We know it's playing a bigger role in the market. And I think it's important for all of us to understand it.
Absolutely. The volumes keep increasing. And so, those dealer hedging flows increase around that. And obviously there's a lot of information from a sentiment perspective we pulled from that. So thank you again for setting this up, and we look forward to talking to you again next month.
We'll see everyone again next month.
This is Justin again. Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
The opinions expressed in this podcast do not necessarily reflect the opinions of Volatility Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital.